Welcome, everyone, to Hard Things Made Easy, or should I say a little easier. Today, we'd like to talk about year 2022, kind of an outlook since it's the January call. Our BridgeRM team is here to help to make hard things easier and help you prevent and solve the chaos created by growth and change. And the mortgage service industry is definitely still experiencing quite a few regulatory changes. So that's why we're here today. I'm Hunter, I'm your host. And with me today, we have Tracy, our CEO, kind of all things in charge here at Bridge. And we have Taylor, who could best be summed up as a compliance nerd. So you're in good hands today as we talk about some of the most frequent, most recent regulatory changes. So Tracy, why don't you go ahead and kick us off for this year and let us know a few of your thoughts.
Thank you, Hunter. It always makes me smile to hear Taylor called a compliance nerd. We all know that's a very true statement. So I'll just get started with some overview here on my end, and thank you to everyone for joining us today. As we see federal financial support going away for individual households, such as unemployment and child care, credit deposits, as servicers, we've got to be in touch with the various levels of assistance that is being provided by federal programs for COVID relief. Where possible, we must ensure that our borrowers are made aware of these programs. So as an extra precaution, we would recommend that our clients consider including the location of where borrowers can find this relief in their communications, whether it's verbal or in writing. So let me walk you through a couple of those resources. First, as you know, the federal government provided resources to the various states in a form called the Homeowners Assistance Fund, HAF as it's more well known. You can find the list of those resources at www.ncsh.org. We'll provide that list for you in an excerpt that we'll provide later. It lists each state and where borrowers can find assistance in that report. So as a servicer, you could easily kind of scrape off those locations of where to send borrowers. And as of this writing, 9 states are accepting applications, and another 20 plus states are expected to accept applications by February for those HAF funds. So for example, you can find the Oklahoma link at www.ohfa.org/HAF. On that page, you can see this large statement pop up that says up to $20,000 in COVID relief is available for delinquent homeowners. We should be referring any of our borrowers with an unresolved delinquency to these sites. And in our opinion, like we said, you should document this referral and even follow up with the borrower to make sure they checked out that resource before moving forward with foreclosure, certainly. Unfortunately, it's not just as easy as that. There's also the American Rescue Plan Act, also known as ARPA. The list of funds by state is not all that useful, but you can find that at ncsl.org or National Conference of State Legislators. Included in the ARPA funds is an option for states to use these funds for aid to households, small businesses, nonprofits, and industries. What this means in reality is that ARPA funds were passed on to counties and cities within each state, and in some cases just remains with the state. But these counties and cities are then responsible along with the states for the distribution of these funds. Therefore, there could be assistance down to the county or city level for your borrowers. Once again, we'd recommend you know where these assistance programs are located and how to refer your borrowers out to them. On a different topic, as interest rates rise and federal government continues to reduce the volume of mortgage-backed securities purchased, we should continue to see interest rates rise, at least to some degree. You know, who knows? We're not economists, but that's kind of our thoughts. And this, could possibly stop or at least slow down some of the market appreciation of underlying properties. We're not market predictors either, but when we see this happen, we always see more borrowers wanting to exit from their properties. And therefore, it's a great time to ensure your loss mitigation applications are familiar with all of the non-retention programs available by insurers and investors. We see on our side that many servicers kind of have a difficult time executing on those non-retention programs because they are so few and far between. And so there's a lot of rules and a lack of familiarity. And so we end up kind of dropping the ball occasionally. So you might want to brush up on those non-retention programs and your quality control, quality assurance around them. Furthermore, we assume you have all seen the CFPB and Department of Justice letter that went out to at least some of the larger servicers. Maybe you were able to see that. It specifically states that they are concerned as a unit about the treatment of service members and veteran homeowners. And specifically, they're concerned about mortgages in a COVID hardship forbearance that have been reported to credit bureaus. We've talked about that issue in the past. Incorrect or confusing communications about COVID hardship forbearances in general, and confusion about required lump sum payments for reinstatement. And it says in the letter that any such actions, if true, may be in violation of the CARES Act, in summary. So anyway, those are a couple of issues that are more global in nature. A couple of more specific items that I wanted to talk about at least is VA in a recent update suspended their inspection requirements when a loan is subject to a COVID forbearance. And that's not a new requirement, but something they pushed out to October 2022. This will kind of help servicers like yourself not worry about this as a to-do item. Also, on a more granular note, a small but important update from Freddie Mac effective March 1st, 22. Freddie Mac requires that servicers notify them within 1 business day if a document custodian no longer meets one of its requirements. We assume this is in response to the mass exodus by big banks from this business. But nonetheless, this change will require that someone is monitoring the eligibility of your document custodian basically every day. So have fun with that. You should communicate with your document custodian and remind them of their responsibility to report their eligibility to you, hopefully making this requirement a little bit easier. That's all for me. Taylor, I'll pass it to you.
Man, I don't know if the industry can handle one more document custodian all of a sudden saying goodbye. So hopefully that's not in store for 2022. But if it is, it sounds like Freddie wants to know about it right away. So thanks, Tracy. I totally agree. 2022 is the year of the half. The homeowner assistance fund, like you mentioned, I think it's going to be a really big deal. And, I'll share some of my other thoughts real quick. I think you hit most of the high points, but one thing that I'm really looking forward to next year seeing servicers getting better at and servicers looking close and regulators looking at servicers closer at is expanding language access. So I'm expecting to see a continued focus on that borrower experience with regard to limited English proficiency. So whether that's customizing solutions or providing just intuitive access to all your available resources in the language that fits them best. I think really the question we should all be asking ourselves this year is, how much friction am I adding to my borrower journey in X sphere when their first language isn't English, whether it's lost drafts or it's a customer service or it's a letter to the president? I think we should just be using that filter. And Tracy, like you mentioned with the SCRA status comment from CFPB recently, it's really the equity of outcomes across all protected classes. So I know we've talked about that quite a bit, but I believe it's also going to be a big year, not just for expanding language access, but also for FHA modernization. This is a project that they've been undertaking for quite some time. And this year, I'm really expecting to see the fruition of all of that labor. So we have a HECM and a Title I servicing handbook in draft form for the first time in 30 years. So, 1994 was the last time that the reverse mortgages were in a consistent handbook. And I don't know if Title I has ever been updated from its initial state. So we're excited to see that. I know those are kind of specialty programs and products, but something that's not necessarily a niche program is the servicing defect taxonomy. I'm expecting that to be finalized this year. Really, that's just FHA's way of standardizing their servicing audit process and how they communicate those results. Really, it shows us how they're thinking systematically about the servicer's program management. So that's going to be a really interesting thing to see play itself out, as well as I think everyone's new favorite system, FHA Catalyst. The migration from FHA Connection is nearly complete. I think servicers now have until mid-February. I know they suspended it to an indefinite period, but I think 2022 we'll see a lot of migration of core operations for servicers into that FHA Catalyst, hoping for nothing but success in that front. But that's certainly going to be a renewed focus for servicers this year. Just system migration, troubleshooting, all of those things, particularly when you're talking about default reporting, something that happens every single month and not just your Part A claims. I think this year we'll really see a huge step forward for the FHA modernization initiative. And honestly, Hunter, I think you'll probably touch more on this, but I'm fully expecting the states to continue their really scope expansion and enforcement this coming year. So I think you have a couple of thoughts for us there, but definitely expecting that to kind of take the center stage this year.
Yeah, that's exactly right, Taylor. And I'd like to kind of focus in on New York a little bit. What you both said, Tracy and Taylor, was really helpful and kind of a broad scope and getting an idea of how servicers might be able to implement certain controls and strategies to servicing, as we do expect kind of lost MIT plans and foreclosures to increase and what we can be on the lookout for there. But I did want to mainly kind of stick to a state jurisdiction point of view, and no better state to pick than New York, with quite a bit of legislative action kind of throughout later part of summer 2021 and then fall 2021, and with some of these things still playing themselves out. So mainly there are two Senate bills that I want to discuss a little bit to drive a little bit of a point home. But the first one being Senate Bill 50001. And in that bill, the moratorium on foreclosures and evictions for that sense was set to end on January 15th of 2022, which is exactly what happened. However, there are still a few reasons to proceed with caution when referring a loan to foreclosure, and especially in New York and maybe some other states that have similar laws and regulations to New York. One of those reasons, and maybe the biggest, is that Senate Bill 50001, the state of New York has established a rebuttable presumption that the borrower faced a COVID-related hardship. So even when there is no formal hardship letter that was sent to the servicer, that rebuttable presumption still stands in any court hearing or administrative hearing in the foreclosure process. So that means that the bar for referring a loan to foreclosure is just a little bit higher now. You should ensure that as a servicer, you possess firm evidence that the borrower was kind of remaining adamant that they didn't face any COVID-related hardship, or maybe that the property is vacant or abandoned, or another reason to provide documentation to overcome that rebuttable presumption. And this presumption isn't diminished, it states plainly in the bill, by simply the absence of evidence that a foreclosing party may bring at a hearing. Matter of fact, the bill states, quote, the absence of a hardship declaration shall not create a presumption that a financial hardship is not present. So in these situations, that presumption is overcome when the foreclosing party, and I quote, attested in a good faith belief that the defendant has not experienced a hardship with notice to the defendant. So there are some requirements there. And so when these foreclosure hearings are set, that rebuttable presumption lies with the defendant, the one who's being foreclosed on, and the servicer or the foreclosing party must show evidence to overcome that presumption. And so this is exactly in line with a letter that was sent from the New York Attorney General's office in mid-December to servicers. And here's just a little portion of that letter that matches up pretty clearly with a couple of these bills. It says, we are now at another critical junction that will require further government industry cooperation. Many mortgage forbearance plans will expire in the weeks ahead, and New York homeowners will again be calling their mortgage servicers for help. Fortunately, many of these homeowners should be able to make a seamless transition into the post-COVID forbearance programs that federal and state authorities require, so long as servicers communicate effectively with their customers. As I emphasized, this is the Attorney General speaking, at the outset of the pandemic, mortgage servicers must invest in adequate staffing and improve their customer communication so that they can handle any surge in requests for assistance. And so the Attorney General there is really just kind of putting out another red flag of the legislator has put some laws into place that we're really not giving up on borrowers yet. And then the second Senate Bill 737 that was passed in New York, is kind of in a similar vein. And this is something that the Attorney General also hit on in her letter to servicers. And this bill requires that each and every principal creditor or debt collector in each initial communication to clearly and conspicuously disclose to the debtor that each communication can be provided in an alternative, reasonably accommodable format. And so, Taylor, this is a little bit of what you're talking about with the limited English proficiency, moving kind of out of foreclosures, what servicers can be doing to ensure compliance. And this is something that New York Attorney James has in mind when she wrote. And again, here's just a little bit of an excerpt too, and she's mentioning exactly this. I, being the state of New York or the Attorney General's office, will continue to monitor consumer complaints and industry metrics to make sure that New York homeowners are not deterred from seeking relief by long hold times, dropped calls, or other communication problems, including a lack of resources for homeowners with limited English proficiency. Servicers should also take a close look at their call time metrics and other policies and procedures to ensure that they do not discriminate against LEP borrowers or have unintended consequences that would prevent homeowners from getting appropriate and needed assistance. It's kind of what's the point of these two bills that I mentioned, and then the letter that kind of ties them both together with the enforcement arm. And this is just in New York, but we can kind of use New York as an example or a standard or a precedent that maybe we could start thinking about in other places, servicers. And really the point is that documentation here is kind of the key to compliance. So that means that documenting everything from borrower hardships or the lack thereof, any attempts to reach the borrower to discuss options based on hardships, this should all be documented. Your procedures and policies concerning borrower outreach, any documentation of hardships, all of those procedures should also be documented too, so that if you do find yourself as a foreclosing party in a situation where you have to present evidence or documentation, you can overcome any presumption that lies there. Also, just as a best practice, it wouldn't be a bad idea to follow some of the practices that you've been following with the CFPB in regards to its procedural safeguards. And although those procedural safeguards have expired, the requirements for live contact statements and reasonable due diligence, those are still in effect until October of this year. And so really, with any loan that's being referred to foreclosure, we still want to really take a look and document well, get a second set of eyes on those loans, and make sure that all of the boxes have been checked, that the servicer has done everything possible to work something out with borrowers. And that's you should be ensuring that the live contact was made, and if it wasn't, that the servicer was reasonably diligent in its efforts to contact borrowers. This whole process should be laid out in written procedures, and you as the servicer documenting each step. So it's very clear now, kind of going into 2022, that most states and their attorney generals and investors, insurers, the CFPB, they're not ready to call it quits on borrowers. They are still have the best interest of the borrower at mind, and you as a servicer possess the burden of documentation and really due diligence as we move forward. And so, although the foreclosure moratoriums have all but lifted nearly everywhere, this is not in any way the floodgates just coming open. Still be mindful of these things. But I think that's pretty much all that we have today. Tracy, Taylor, if you guys don't have anything else, we deeply appreciate everyone for joining us today. You can always reach us online at bridgerm.com, or you can reach Heather, who manages a lot of our relationships, at heather@bridgerm.com. We really appreciate you taking the time for our call today, and we hope that everyone has a great 2022 and that your year is off to a great start. Please let us know if we can help you in any way in your organization, especially based on the things that we talked about today. So we appreciate it. Thank you very much, and have a great day.